Thanks so much for coming. I'm Jeff Colgan. I'm the director of the Climate Solutions Lab, and this year I'm the director of the Rhodes Center as well, which is the real host of today's event. And it is my very great pleasure to welcome and introduce Javier Blas, who is the author of this book, The World for Sale. This is my copy that I got him to sign just about an hour ago, but I have had this copy for quite some time because I bought it, I read it cover to cover, and then I started assigning it in my classes, in particular my class on the geopolitics of oil and energy, because it is so interesting and so little known, I suppose. It's like a window onto a world that is really important, and yet many of us don't really understand. I think it's not too much of a stretch to say that Javier and his co-author Jack Farchi are, sort of the world-class experts on understanding both the big picture about what's happening in this sector, but also some of the sort of fascinating fine-grained details of it. So Javier is a Bloomberg Opinion columnist now, covering energy and commodities, based in London, but he is formerly the chief energy correspondent for Bloomberg, and before that he covered commodities and Africa for the Financial Times. So he has this long pedigreed career in journalism, which started in his native Spain. And so please join me. He's going to talk for about 35-ish minutes, and then we're going to have lots of time for Q&A, and I'll ask you, at that point I'll moderate the conversation, but I'll ask you to line up and use the microphones if you have questions for him. But please join me now in welcoming him to Brown University. Thanks.
Thank you, Jeff, for your very kind introduction, and also for inviting me here to Brown. I only arrived yesterday, and I have the opportunity to walk through campus and enjoy a bit of the sunshine and go to what I think that is called as the main green. And since then, I have been plotting for ideas of how to get a professorship here with tenure, if possible, and relocate right away to Providence. Obviously, then today the weather looks more like London, so I'm now just kind of reconsidering my whole attitude to it, but it's lovely to be here at Brown University. Thank you so much for inviting me, and thank you very much to all your team, and particularly to Ali Batten to make all of this possible and just make sure that all the logistics were working. Good afternoon, everyone. My name is Javier Blas. It's my great pleasure here to join you today for the third annual William Rhodes Lecture Series on the Ethics of Capitalism. So one housekeeping announcement before I start. As Jeff explained, my day job is with Bloomberg Opinion, but all my views today are my own views and do not represent my company or my affiliation. So I'm speaking on my own name. And also I should acknowledge that a lot of what I will speak today over the next few minutes is based on research and writing that we did for The World for Sale, a book that I co-authored with my colleague Jack Farchi. So Jack, in so many ways, is also responsible for this lecture, although he didn't have the opportunity, as he's traveling in Chile covering a mining conference today, he didn't have time to edit my test. So you will see there's plenty of Spanish stuff and a bit of Spanglish there, and Jack will be absolutely terrified with it. But anyway, here we go. So let me just start talking about commodities, and by that I mean all kind of natural resources that we use in the global economy. Obviously, oil is the largest one, and usually the one that gathers most of the attention. But when I think about commodities, I'm thinking about everything natural resources. It could be as fundamental to the global economy as the price of oil, or even more fundamental to the livelihood of English people, that is the price of tea. There are two commodities that I absolutely need to pay a lot of attention on my job in London. One is is oil, and the really important one is the price of tea. I mean, that is the kind of thing that really gets society going if you are based in London. But my fascination with this sector, with commodity trading, started about 25 years ago as I was a wannabe reporter or wannabe journalist in a Spanish newspaper. And I have just left college, and my dream at that point was to become a foreign correspondent. That's what I wanted. It was more than a foreign correspondent. I wanted to be a war correspondent. Perhaps I have spent too much time watching movies about reporting and journalists. I mean, all the Watergate case, and perhaps I just watched too much The Year of Living Dangerously, and I thought that I have the looks of Mel Gibson on when the young one. I don't know what it was, but what I wanted to be was a war correspondent, and that's what I wanted. Somehow, however, I ended on a business newspaper on the early shift writing about the CPI data, industrial production, and a very important indicator if you are covering the Spanish economy, which is the number of people who have slept on a hotel over the previous 7 days. So I was doing that. I was feeling quite miserable with myself. And one of my friends from university and probably drinking companion at that point said to me, why you don't just write about oil? Because you want to be a foreign correspondent. If you write about oil, you will go to the Middle East, and there are always wars at the Middle East, so you're going to be fine. This was 1999, and amazingly, the price of oil at that point was under $10. I checked earlier because I was with a group of students which are interested in journalism, what was the price of gasoline in the United States at that point. When I joined my newspaper, the price of gasoline was $1.17 per gallon, 1999. How much time has changed? No one was very interested in my newspaper about oil, so my editor said, you could do oil on your spare time as long as you are covering, all those indicators that you are covering. But he said, no one is really interested in oil. It's all about internet these days. So why you are interested in oil? I said, it's the Middle East and so on. So anyway, they accepted. And within a few weeks, I rang the local oil company, and I said, look, I'm interested in how you guys buy crude oil. I mean, what is the process? How you get the crude oil, and how a barrel of oil gets from, say, Venezuela or Mexico or the Middle East into a Spanish refinery, and then gets gasoline, and people go to the gas station and they fill the cars and so on. And astonishingly, not only they explain the whole process, but they say, why you don't come over and spend a couple of days on the trading room and see how it's done? I mean, that would not happen today. I tell you, an oil company doesn't invite a journalist to see an oil trading room these days. But anyway, so I went to the oil trading room in Madrid, and that's the way that I ended for my only time on my whole career buying a full cargo of oil, 2 million barrels of oil. I mean, all said, I didn't really buy it. The trader bought the cargo, but I have a second-hand set. And he was on the phone, I was on the phone, and he was chatting with a trader of the Iranian oil company when it was legal in Europe to buy Iranian oil. The guy was in Tehran, and they haggled about the price, and it's a few cents up or down, and so on. And and I'm listening, and I'm just absolutely mesmerized that they are talking about buying 2 million barrels of oil over the phone, like, who orders pizza. And I was like, wow, this is absolutely incredible. And at some point, they reached a deal. It was about $20 million worth, 2 million barrels on what is called a VLCC, very large crude oil carrier, what we call a super oil tanker, one big tanker. And as I'm listening, one of them says, do we have a deal? And the other say, we have a deal. And it's like, well, thank you very much. It's a pleasure to do business. Deal is done. And I'm like, what do you mean? And what do you mean the deal is done? I mean, and then the person tells me, well, we just bought 2 million barrels of Iranian oil. That's it. I say, how? I say, well, he said, do we have a deal? We agreed on prices and conditions. He said, we have a deal. I say, agree, and that's it. I'm like, well, what do you mean? This is all done over the phone. I say, well, that's how it works. We do things, and it's an industry that my word is my bond. We have done a deal. So don't worry, they are sending confirmation in writing by telex. This is pre-fax. for the younger people, a pre-email. And certainly a telex came, and the Iranian National Oil, no, in the name of God Almighty, the Iranian National Oil Company wishes to confirm, it's simply a confirmation. The deal was already done. I have that telex still is framed on my office at home, and I have the details of the transaction, the date I bought 2 million barrels of Iranian oil. Don't tell US Treasury, please, or I will never come back to the United States. Anyway, but I was fascinated because I kind of discovered that it was a war, a business war, an economic war, where dozens of men, I'm sorry, it's still a world that today is dominated by men, very few women, sadly, working in this industry, that they were buying and selling cargoes of oil and other commodities over the phone, making businesses will have huge economic implications for local economies as the exporters, local economies as the importers. And it was a fascinating war, full of fascinating characters, entrepreneurial and charming, also ruthless and amoral. If I was to think of, on Hollywood terms, how an oil trader look like, what the characters of movies that we all know look like, well, I think that the archetypical oil trader will have something of 007 James Bond, certainly, the adventure, the political intrigue, the geopolitical play. It will have something of the Wolf of Wall Street because, it's this ruthless character driven by money and basically nothing else. It will have perhaps something of Pirates of the Caribbean, the pirate of Pirates of the Caribbean, I forgot the name, but kind of that character, but also something of Moneyball. These guys really know their business. They are extremely analytical. They don't really, this is not about just jumping on a plane and getting a deal. They really think all the numbers through, et cetera, et cetera. So for the last quarter of a century, and that's not all, the gray hair, I have just kind of devoted myself to find out about more of these men and few women who are the community of commodity traders that effectively, I say sometimes, run the global economies, the commodity traders that buy and sell the planet natural resources. And they are a bit of the underbelly of the global economy. Whether we know it or not, we, and including everyone in this room, we are the customers of these commodity traders. We take for granted the ease which we fill up our cars with gasoline, buy an aluminum case for our smartphone, like my iPhone, or order a cup of coffee of Colombian origin. But all of that, all the modern economy, is built on natural resources. And for that, underpinning all this consumption is a frenetic trade in international commodities. And the people who are underpinning that trade is what we call the commodity traders, the trading houses, the independent commodity traders. They are mostly in Switzerland, sleepy towns in around Lake Leman, Geneva in particular. They are here nearby, a big community of commodity traders around Greenwich and Stamford. You take the Acela, you may see them on the first class compartment. They are also increasingly in the east, Singapore, Dubai, certainly Hong Kong, Beijing, and more Shanghai. Without the commodity traders, gas stations will run out of fuel, factories will grind to a halt, bakeries will not have flour. They are, I call them, the kind of the lubricant that grease the global economy. Few people, including in business, know their names, know what they do. There are companies like Vitol, the world's largest oil trader, Cargill, the largest privately owned company here in America and the largest trader of agricultural commodities. Glencore, the largest metal trader and on aggregate, the company that trades more commodities in the world. But there are many others, perhaps some of them more famous than others. You have Trafigura in metals, Gumbor Mercuria in oil, ADN, Louis Dreyfus, Bunge in agriculture. They are huge companies, huge revenues, employing lots of people. Very few people know about them. When I started writing about them, a lot of times I need to explain to my editors the size of these companies to really get their attention, because they're like, why are we writing about a company that we have never wrote about, that no one really knows by name? Why we are writing about this? So just let me give you a few, factoids, as I will call it, about these companies. I mean, let's start with Vitol, largest oil trading house, owned by their staff, privately owned, profits of more than $10 billion a year for 2 consecutive years. And this company alone trades more oil than the combined consumption of the leading economies of Europe. Vitol can supply single-handedly the economies of Germany, France, the United Kingdom, Spain, and Italy, and to spare. And very few people know about them. What about Cargill? Cargill is an American company, known well if you are coming from the US Midwest, less known outside the Midwest. Do you have a sense of how many employees work at Cargill worldwide without using Google? Anyone want to guess? How many employees this company that probably you have never heard of? Guess, wild guess. Anyone? Jeff? 80,000. It's 160,000. It's double the amount of employees on the Coca-Cola company, just to put a benchmark. It is a huge company, $7 billion profit, owned by 2 families, linked by marriage many, many generations ago. But effectively, the Cargill and Macmillan families, they got together through marriage. So let's call it the family that owns Cargill, counts 14 billionaires within the family. So, Uncle Cargill and Auntie Cargill and the cousin and the niece and so on, there are 14 of them with more than $1 billion. That's the largest number of billionaires in any family in the world outside the Middle East royal families. Again, very low profile, very interesting company. Or a company that you probably have never heard of, Neumann Group. German company, privately owned by the Neumann family. For every 10 cups of coffee that you drink, at least one, the beans were traded by the Neumann family. Largest coffee trader in the world, based in Hamburg. Again, completely low profile, it's one of those almost invisible giants of global business that no one knows about. Very profitable, about 75, 100 years old. Very interesting companies as case studies. And what about the profitability of the big traders? Well, you look at 2022 data, which is the last financial year, we have a complete data set for a lot of these companies, and also because a lot of them are privately owned, they don't release publicly their financials, so it just requires certain imagination from journalists to get the data. It's possible to get it, but it requires a bit of an effort. But so let me just give you the 4 big ones: Vitol, Glencore, Trafigura, and Cargill. They made in profits in 2022 a combined of $50 billion, just almost $50 billion, 40 and a bit. That's more or less as much as Exxon made. Yes, Exxon is a single company here. I'm putting 4 companies together, but it gives you a sense of size. These are very significant business. But the difference of Exxon, which is owned by millions of shareholders through pension funds, et cetera, publicly listed company. Here we are talking about, of these the 4 companies that I mentioned, only one is publicly listed, Glencore. The 3 others are owned either by families or by their own staff. I mean, these companies are full. I mean, the CEO usually is a billionaire. The CFO is a multimillionaire. The riches of these companies are just spectacular. So, and there is also a very important consideration here. There is hardly any regulation on this sector. Physical trading is beyond most national jurisdiction. Often it happens on the high seas, where no one is looking at it or regulating it. Banks tend to be quite regulated. Financial markets are very regulated. So there is a sector of commodity trading that is quite regulated, with the financial side of it. But the physical side, where people are buying and selling a cargo of oil a cargo of wheat, a cargo of copper. That is hardly any regulation whatsoever. And there is not an international body that is in charge of this sector. There is not a World Trade Organization. There is not a UN organism that will just kind of keep an eye on this. I mean, one of the most worrying aspects of commodity trading recently over the last few years, and Jeff was very generous calling Jack and I experts, but in some ways, when we published the word for sale, we kind of became the go-to people to ask questions about, including from central banks. And I always, on government officials, I was a bit worried, would say, look, I'm a journalist. I wrote a book. If I know something, I usually publish it. Surely you have better people to go to ask questions. I mean, you are a government official, you should really have better people. And the answer was no, and kind of an indication of how little regulation it was and how surprised government officials were when they started looking at the profitability of some of these companies. So what commodity traders do exactly and why we do need them? I mean, at the end of the day, they're just buying and selling. How, on the era of Amazon and eBay, why we don't do this on a different way, and we don't use all this complicated. I mean, the basic business of a commodity trader is what I call disarmingly simple. They buy natural resources in one location and time, and they sell them in another location and time, and they hope to make a buck on that transaction. You repeat that many times, millions of times, and then you will be making a very, very good business if you get it right. That the key one is getting it right, because this is also a pretty risky business. The role exists because supply and demand in commodities rarely match in real time. The market always is either oversupply or undersupply over time. Obviously, when you look at the space of a year, the market may look imbalanced, but we may have overproduced a commodity during the spring and then overuse it during the summer, and then changes on the autumn and the winter and so on. So you need someone to balance the flows of the commodities, that have inventories, and that they can move things around. There are times where commodity demand may be weaker in America but stronger in China, and vice versa. You need someone to redirect the flows, and that is the arbitrage that commodity traders do. Because they are doing multiple deals and they are buying and selling, they are generally, the price of the commodity itself is irrelevant to them. They don't care whether prices go up or down. They focus on the price difference between times and locations and qualities. But they don't make more money when prices go up or less money when prices go down. Indeed, at times, a commodity that is going down, a market that is going down, is extremely profitable for commodity traders because they could play storage deals, which are very profitable. And we saw that during one of the best years of the commodity trading industry was actually 2020, during COVID. They make huge amounts of money buying oil, storing oil everywhere that they could, including turning some super tankers into floating facilities. President Donald Trump referred to it on the White House. I was absolutely mesmerized by when he talked about these deals, what we call contango plays, and he kind of struggled explaining how it worked. But effectively was so amazing that even the President of the United States referred to them on the podium on the White House, and they kind of, the lore indicates the fame of the commodity traders, that they are speculators and they make their money always when the market goes up. They are profit sharing. The reality is that a bearish market, a market that goes down where demand is collapsing, could be extremely profitable to them. But it's by exploiting these price differences what they make their money, therefore they make markets more efficient, the global economy benefits, and they get paid to take that risk that they are taking. At the end of the day, they are putting their capital at risk to move all those commodities around the world, and that needs to be rewarded. We can discuss whether the reward is too high, whether the taxation is high enough. There is a very interesting consideration on these commodity traders. There is very little regulation of the sector. They have chosen to locate themselves in jurisdictions where the regulation even is more lax, or there is an absence of regulation. So you see that they are located mostly in Switzerland, very few in the United States, Switzerland, Singapore, Dubai, Shanghai, locations where not only regulation is lax, but taxes for commodity traders is very low. Goldman Sachs comes to pay a corporate rate on average, varies year to year, but Goldman Sachs, which I will think that it has a very good tax department that runs their business in a way that they pay as little as they can on taxes, but they come to pay something around, say, 20 to 25% tax rate. Commodity traders typically pay 10. That's how good they are. There is a trade unit, a commodity trading inside, sorry, let me put it this way. Shell, the oil company, has a commodity trading inside Shell, buys and sell oil. Inside that commodity trade unit of Shell, there is even a smaller unit, which is located in the Bahamas. And the tax rate there is 0. And their profits, because they have to disclose it for a number of reasons, runs about $1 billion a year. So Shell has a trading unit in the Bahamas which buys and sells West African crude oil. You will wonder why you need to be in the Bahamas to trade West African oil, but that's another question. And the tax rate that they pay is 0, and they make $1 billion, and that small unit employs 35 people, which I think are the most productive 35 people that any oil company employs anywhere on the planet. Despite all the perhaps you could be thinking, oh my God, this is really sounding bad, we do need the commodity traders. The global economy will not work without them. They do take risks, they benefit society, they benefit the global economy. So the question is how to make sure that the business is done properly. There is a very important aspect of commodity trading that goes beyond business and economics and goes into politics. Because to understand the interplay of money and power, to see how oil and other commodities flow from resources-rich countries, no matter how corrupt or war-torn, into the world's financial centers, you need to understand the role that the commodity traders play at the center. And it is really a role that goes beyond the economics and have a political impact. They are a bit of a throwback of what I would call a bygone era. They are ruthless, charming, but they land deals where competition will not go. I say that they are the last swashbucklers of global capitalism. The appetite for going anywhere sometimes also gives them a bit of a post-imperial or post-colonial air. They are overwhelmingly white men at the top of the companies. They do business mostly from Western capitals, from Europe and the United States, in countries in Africa, the Middle East, and Latin America, buying natural resources. For most of them, the world is their natural place. I mean, the world is where they do business. Where and how far they are prepared to go, it varies, depends on the appetite of each of the companies. Some of them are very happy to work in industrialized countries and the more developed emerging countries. Some of them are willing to go anywhere in the emerging market world. And for perhaps the most buccaneering of the commodity traders, the seal for business opportunities extend also to war zones, which often are very profitable if you are a commodity trader. So how is this interlink between politics and commodity trading? Well, I'll give you a few examples. In Iraq, in the late 1990s and early 2000s, the commodity traders helped Saddam Hussein to sell his oil, bypassing United Nations sanctions. In Cuba, they swapped sugar for oil for Fidel Castro, helping to sustain the revolution afloat when he was in trouble after the collapse of the Soviet Union. In South Africa, during the worst years of apartheid, when most Western countries have put quasi-embargoes on the white racist government in Pretoria, the commodity traders were the ones who supply the government of South Africa, the apartheid government, with the oil that otherwise would not have got. And probably they prolonged some people, including within the commodity trading industry, they believe that they prolonged 10 or more years the apartheid regime. And more recently, a new breed of commodity traders with names changing almost every week. When the US Treasury sanction one, another one is created. New commodity traders are helping Vladimir Putin of Russia to continue selling his oil well above the G7 price cap, making billions of dollars from the Kremlin, which are obviously being used to finance his aggression and war against Ukraine. And these are not some of the commodity traders that I was talking to you earlier. They don't go as far as getting with Vladimir Putin now. But they're a new breed of commodity traders. We know very little about them. We don't know who is behind them. They're acting with shell companies in offshore centers. But some of them have interesting names. The most popular and bigger of the new traders who are dealing in Russian oil is called Bellatrix, which my 10-year-old niece tells me is the buddy of Harry Potter. To write The War for Sale, we spoke with dozens of commodity traders, many of them retired. And let me recount to you a story that we heard from one of them. He was a senior trader based in the former Soviet Union. And this company in particular, it was Rhodes and Glencore, two companies there, were doing a deal financing the government of Tajikistan. It's one of the former Soviet republics bordering Afghanistan in the early 1990s. Tajikistan saw perhaps the bloodiest of all the civil wars of the disintegration of the Soviet Union. It was really, really bad. And aluminum, you say aluminum here. Aluminum was the main commodity and the main source of income for the government, was fighting the civil war. But it needed a commodity trader to effectively the promise of delivery of several months of aluminum and getting the cash in advance. So a commodity trader accepted. You see mine, just doing a deal with a country that is in the middle of a civil war and seeing that as part of your normal business and offering credit in advance on a country that is on a civil war. I mean, when I was getting my mortgage for my house, I had to do so much paperwork. I have gotten a payment from JP Morgan, from my book, actually, royalties, from America, and the bank really questioned every small amount of money that was going in the account. And here you have commodity traders that are bloody a civil war in Tajikistan, and this is good business. I mean, they are in a complete different world. But this trader, we were talking to him and said, so how was it? I mean, you were financing a government was fighting a civil war, and thousands of people were dying, and we were expecting a response on the sense of how difficult, how dangerous, how perhaps with hindsight was not a really good idea to do that. And what he said, and this was on the record, quote unquote, it was a stunning business, actually, because it was a civil war. It was a little bit risky, but we made a lot of money. I mean, you see the difference. And commodity traders often get into those sort of deals. One of the most popular deals in oil trading and physical trading is lending money to a country and in advance of future deliveries of oil. It's called a prepayment. And the oil, the future flow of oil is the guarantee of the deal, similar to what a house will be the guarantee of a mortgage. And countries can get finance when they need the money, just effectively, in some way, just bartering future production from immediate access to cash. These deals, which are now done very often, have been used in multiple locations. But the pioneer of these deals in the 1980s was Rhodes. We consider the godfather of the oil industry. And the place where these deals were done first in a significant scale was in the early 1980s in Angola, where the Angolan government was fighting also, the communist government of Angola was fighting a civil war, which also brings an interesting, I mean, these are the most capitalist executives I have met on my life. Nothing will deviate their course to make money. And here they are financing a communist regime backed by Moscow in the 1980s on a civil war. But they don't care about political colors. I was talking to one commodity trader, and I said, so what about, politics? I said, I don't care. Red, blue, they're all the same. I only care about one color. I was expecting, I don't know, what is the new color? Green, the dollar. That is the only thing that really matters for a commodity trader. Do you remember the oil trader I told you at the beginning that I was just listening as he was buying the 2 million barrels of Iranian oil? A few years later, I think it was 2 or 3 years later, about that conversation, I bumped into the same trader, and I was in Baghdad, 2003, January 2003. The invasion was going to happen only a few weeks later, and I saw him on the lobby of the hotel, and I was like, goodness, what are you doing here? I said, well, have a few meetings and doing a few things here. But just only a couple of days, and I'm leaving. He was obviously there buying oil from the regime of Saddam Hussein, and literally this is just 6-7 weeks before the bombings are starting to fall on Baghdad. This is the kind of business that, when I say 007 James Bond, a bit of the character, it's just because the lobby of a hotel in the capital of a country that is going to be about to be invaded or is about to go under a civil war or is in a civil war is a natural place for some of these commodity traders. And we can look from our position here and saying, well, is any morals on it? Is there any ethics on it? But at the end of the day, we are all using their services and we are all consuming the natural resources that they are providing. Let me, as I'm going to go, it's about 6 minutes more. Let me just give you a bit of a quick historical summary of how the industry developed, and then we will go a bit more on the ethics of capitalism in the industry. In commodity trading, obviously, is as old as mankind. We have since the early days we have barter trade, grains and metals and stones. For other commodities and later for money. Indeed, the tendency to track and to barter, to trade, is seen by anthropologists as one of the activities that mark the beginnings of modern human behavior. Over centuries, that trade grew in both size and complexity, and the first commodity trading companies, as perhaps we can define from the perspective of 2024, started to emerge around the 16th century. One of the first ones was a German family called the Fugers, which made a lot of money trading on copper and mercury and financing the Spanish crown in some of these not so nice activities in Latin America. Another example of those early days, again, a not particularly beautiful example, is the East India Company that effectively ran the South Asian subcontinent for many decades. But the history of commodity trading, as we know it now, only took shape after the Industrial Revolution, thanks to advancements both in telecommunication and transportation. Those advances changed completely the way that commodity trading could be done. In 1858, the first telegraph line across the Atlantic opened, and it is an amazing development. It cut the time that it took to deliver a message from London to New York from 2 weeks by vessel to minutes. Just in mind that you could do an order to buy or sell. Previously, you have to send a letter, put it on a boat across the Atlantic, and then you have a telegraph line, and within minutes you could transmit the message. Some of these commodity trading houses have historically some of the best telecommunication networks of the planet. Philip Brothers, which was one of the big companies, claimed that they have the second, in the 1960s, they have the second best telecommunication system in the world. The first one was the Pentagon. They claimed they have the second best one. And I do believe that probably that was true. I mean, they really invested heavily in telecommunications. the other big invention, obviously, the steamship. For the first time, that meant that you could do commodity trading over long distances, not just at the mercy of winds, but using coal as your source of fueling. And that meant that the cost of transportation fell significantly, and not only tea, spices, and precious metals were worth transporting over long distances, but anything else from copper to grains to much later, obviously, oil. A great number of commodity trading houses were born during the 1800s. Some of them are champions of the industry today. Cargill, for example, was founded in 1865, only 7 years after that first telegraph line across the Atlantic was put in practice. But it's really after the years of the Second World War where the modern commodity trading industry, as actually we know it today, was kind of developed. And perhaps is the first industry, earlier than I will say that banking, that not only took advantage and benefited, but I think also shaped globalization. I think the commodity trading perhaps is the first industry of the globalization and really did a lot to create the globalization. There are 4 big trends over the last 75 years that they have contributed to the development of the industry as we know it. The first one was the opening of many markets that they were previously vertically integrated, controlled by a few companies, above all the oil market, which was previously effectively controlled by 7 companies. We used to call it the 7 Sisters. And in the 1960s, you could barely buy any crude oil on the international market. By 1973, it was almost a free-for-all. By 1979, the market was completely open to commodity traders. The second big development was the collapse of the Soviet Union, which opened a complete new market for the capitalist system, but also a market that was a large producer of many commodities. And Russia, by the time of the collapse of the Soviet Union, was one of the largest oil producers, was a significant producer of aluminum and a number of other commodities. And today, Russia is, again, one of the largest producers of many, many commodities, from wheat to nickel, natural gas, oil. The third development was the rise of China, obviously, from the mid-1990s onwards, but particularly during the first decade of the current century. And China is absolutely amazing. It went, in 1993, China was a net exporter of oil. It was indeed selling quite a lot of oil into the United States. And there were some trading companies here in the United States which have developed a very nice niche market for themselves, buying Chinese oil for refineries in the west coast of the United States. Today, China is the world's largest importer of oil. You know, in use less than 30 years, how much has changed. And the fourth and final trend was the financialization of the commodity markets and also the growth of the banking sector and the commodity trade finance sector, particularly from the 1980s onward. I mean, looking at oil trading in particular from the perspective of 2024, this may sound completely unbelievable, but until the late 1970s, that's my timer. Until the late 1970s, the main commodity traded at the New York Mercantile Exchange was not crude oil. Indeed, the first crude oil futures contract was not launched until 1983. Does anyone know what was the most popular commodity trade at the New York Mercantile Exchange in the 1970s? Any wild guess? The commodity was the potato of Maine. And when the market for potatoes from Maine was cornered in 1976, the story made the front page of the New York Times. I don't really think that is just such a big change from today. Let me go to a bit of the ethics. When Jeff suggested that I came to Brown University to speak about commodity trading and the ethics of capitalism, I must confess that I had to reach for the dictionary. English, as you see, is not my first language, so I have my dictionary always close by at home for these issues. Ethics, what exactly means ethics in English? I really needed to check, because I was not sure on the context of commodity trading. So the Merriam-Webster dictionary that I keep at home says that ethics is a set of moral principles, a theory or system of moral values. Well, I thought to myself, that's going to be a bit of a problem, because there is no such a thing in commodity trading of a set of moral values. It's just making money and move the commodities. So how I'm going to talk about this? Look, the industry has had historically a big problem, and it has been endemic corruption on it. Bribery, money laundering, just plain corruption, and also market manipulation. This is something that the industry has denied for long. And you know, some commodity traders were quite open about this. When we spoke for our book with Torbjörn Tornqvist, which is the co-founder of Bloomberg Group, one of the world's largest oil traders, he said to us, there are a lot of skeletons, and many of them, most of them, will never be surfaced. I mean, when the CEO of a commodity trader tells you that there are many skeletons, I suppose that he knows about it. It has taken quite a lot of time for those skeletons to reappear. It has taken a lot of work from the FBI in particular and the US Department of Justice. But now those skeletons are being surfaced, and it's a bit of a graveyard of bribes paid to government officials on return for very lucrative contracts. We know that thanks to the work of the FBI and the U.S. Department of Justice. 5 of the largest commodity traders have admitted over the last 3 years that they pay bribes in the past. In one case, as recently as 2020, and only they stopped because they got a subpoena from the U.S. Department of Justice, and they found themselves under investigation, so they have to stop. I mean, obviously, the industry disagrees with my view that there is a lot of corruption in it. They say that this case represents behavior of the past, and it's true that in some cases, some of this bribery happened a decade ago or so, and maybe the companies have changed. But I mean, I think that those protestations of innocence will be a lot more convincing if the same firms hadn't made the same claims before, all as they were paying the bribes, as we know now. And also some of the firms which got, and they plead guilty on charges of bribery recently, it was not the first time that they got caught by the US Department of Justice. It was the second time that they have been got. To me, and perhaps you have been following this on Bloomberg and other news organizations, the big eye-opener was recently the trial of Javier Aguilar, a mid-level executive at Vitol Group, as I told you, the world's largest oil trader. Aguilar has just been sentenced to as many as 30 years in jail after a jury delivered a guilty verdict. His lawyer has said that he plans to appeal. And the case has literally everything. It was 3 weeks in federal court in Brooklyn. And you could imagine this was for a reporter who follows commodity trading. This was like a Netflix series. I mean, literally live there. Everything that you wanted to know, all the depositions, all the witnesses, all the FBI wiretaps, secret videos. It was bags of cash, expensive watches, clandestine meetings, very profitable deals, and above all of it, bribes, and more bribes. At one point, one of the attorneys asked, it was a bit bemused because he's just realizing that they were bribing everyone. And he said, but you were not trying to bribe the Secretary General of the President. He refers to effectively the Chief of Staff of the President of Ecuador. And the witness says, oh, I intended to do it, yes. I mean, they were literally going up to the very top. There was a couple of really Kafkaesque moments in the trial. The jury proceeding is a federal judge who has done several cases of mafia deals, and he had to ask the attorneys to slow down and said, there are so many conspiracies here. I want to make sure we are in the right conspiracy as we are discussing the case. Full disclosure, as we are talking on the Aguilar case, because someone could see me as biased on this particular one, during the trial, the prosecutors play a tape of a FBI wiretap where it was just, secretly recording the phone of this oil trader, and he can be here referring to me as the asshole. So I am not biased, but I thought that you need to know that. Look, the Aguilar case was explosive, but there were many other lawsuits over the last few years, about 15 lawsuits against commodity traders, individual traders, intermediaries of the traders, and the landscape that emerged is one where bribes were paid as normal course of business. There was one particular example that it was really shocking to me, which Glencore, world's largest trader in 2011. South Sudan has just won independence. It's a country that is barely a few days old as an independent country. And what the oil traders of Glencore are doing, they get a private plane out of Switzerland, they fly to Juba, the capital of South Sudan, with $1 million in cash, and they pay bribes. I mean, just in mind, the first thing that the oil traders think, this country has just won freedom after a civil war with a neighbor on the north, a few days only. I mean, literally, it's less than a month. And the oil traders are already there paying the bribes. There are, of course, expensive watches, the Philippe Patek, et cetera, et cetera. And it's not just one or two cases. I mean, on the last few legal cases that we have seen only in the United States, there were bribery payments in Venezuela, Mexico, Brazil, Angola, Ivory Coast, Republic of Congo, Nigeria, Malawi, Cameroon, Ghana, Equatorial Guinea, and South Sudan. I mean, that is quite a long list. And when they said to me, well, these are isolated examples, I said, well, for isolated examples, you really are bribing half of Latin America and the other half of Africa. So and a big problem here is that we are not doing enough to make sure that this don't happen ever again. The fines are not strong enough. People are not yet going to jail. And when some people are going to jail, is the junior and mid-level traders, not the CEOs at the top of the companies. Are the sanctions strong enough? Well, not really. When Gumbor recently was sentenced in Switzerland, the fine was 4 million Swiss francs. That's about $5 million. I mean, for a company that regularly makes $1 billion in profit, you will see that that's just, as some people will put it, cost of business. But it's also interesting. This is improvement. Until 2012, in Switzerland, was not only legal to pay certain bribes overseas, but also the cost of the bribe can be used as a tax credit. You hear that well. Until 2012, bribes in Switzerland were tax deductible. Just mind that you are just filling your corporate tax record, and we just pay some bribes in. I'm going to use my home country, Spain. We pay some countries some bribes, bribing some business person in Spain. Here is $1 million, and we are going to take a tax credit here. So the new regulation are a bit of an improvement. I finish emphasizing the need to reform the industry and increase the penalties for wrongdoing, because this is an industry that is absolutely necessary for the work of the global economy, for the world society, but there's also an industry that is going to play a massive role in the fight against climate change and the energy transition. We do need commodity traders if we are going to get the energy transition to work. At the moment, a lot of these commodity traders are the channel that links producers of fossil fuel with us, the consumers. In the future, these same commodity traders will be needed to be the channel where a lot of the critical minerals and the electricity is traded. And they are taking positions. If you think about Glencore, world's largest commodity trader, it is the largest trader of coal today. It is also today the largest trader of cobalt, the mineral that is essential for the batteries on Teslas and other electric vehicles. So they have both both hands in the commodity and the energy transition, both on the fossil fuels and on the new electrify everything. If we think also about electricity, the commodity traders are going to play a big role as we electrify everything. We bring more renewable generation, that's solar and wind, that only comes when the sun is shining and the wind is blowing. So we need a commodity trader to smooth out the ups and downs of the electricity sector. And for that, we are going to need then, I think, more than we needed before. But for society to be able to thrive, we need that they are reliable, but we also need that they are honest. And with that, I will stop. Thank you so much. And Jeff.
Terrific, Javier. So we'll just share a mic. I'm going to invite questions from the floor, but I'm going to kind of kick things off by just asking one or two to start. So please, by all means, if you have one, think about what you might like to ask Javier. So the question that I want to start us with is, I think you really nicely lay out how this is an industry that has a kind of legitimate space as a lubricant of the global economy. And then there's also a part of this industry that is like clearly off limits, like flagrantly,
It's the more lubricant side.
Yeah, I mean, they're flagrantly disobeying like sanctions, or they've got, I think at one point in the book you talk about how they have these stamps that are custom stamps to authorize, shipments across borders. And they've got, like in a filing cabinet, they've got like a bucket of these stamps so they can just do like fake stamps wherever they need to go. Okay, so those are clearly like not okay. But what about the space in between? And I wonder if you could just imagine that you've got, in this room, Joe Biden and, the Chancellor of Germany and Xi Jinping and, the whole set of policymakers in front of us. And they say, okay, Javier, what do we do? Like, what do we do to constrain that gray space? How do we approach it?
The first thing that you need is data. I mean, one of the big problems that right now we have with commodity trading is that we lack a lot of understanding of the industry. Much that I'm proud on the book that this is seen as the best source of information. It is an indication of how lacking the data is. It was very interesting during the European energy crisis in 2022. The Bank of England in particular did a bit of work on what was happening in commodity trading markets, and a lot of what they got back was opacity. We do not know what's going on simply because we don't have the data. A lot of these companies are privately owned. They don't have any obligation to provide any information. And to me, that's quite scary because it's, as a central bank effectively saying, we do not know what's going on. Nothing is worse than the unknown knows. And this was basically the first thing I will say is we need better data. We need governments forcing some of these companies to disclose information. There was an agreement by the G7 to make every physical oil transaction, to make it public on a public register. Similar to what we have now for swap, for some financial deals, where everything gets aggregated and provided so regulators can take a look. And the G7 agreed that was going to be the case, that physical oil transactions will go into a registry. The agreement from the G7 is from 1979, and it has not been implemented. But it was agreed. All the countries that issued the communiques on the Tokyo G7 meeting, I think actually it may have been a G6 rather than a G7. So some of the things that we need is just implement actions that we agree 40 years ago. If we get that, then we can start to understand the sector. We can understand who is trading what, and then we can, we will have a lot more transparency, and then we can see whether policy action is needed, whether we're missing something. I will say that taxation is another area. Minimum taxation levels, the OECD is working on this, but it doesn't seem fair to me that that commodity traders pay half of the taxation that other companies are paying when they are operating in some cases for similar jurisdictions. So that will be also a very important area.
Great. Thank you so much. Okay, so I'm going to ask my second question, and then I'm done. So it's all up to you guys in terms of what we talk about. But I'm going to shift from the ethics question to the climate question. And I guess I'll make this as simple as possible. When we see a company like Glencore or some others, Glencore hasn't done this, but some of the other ones have said, okay, we're out of coal. Coal is like too much trouble, it's too bad for the climate. Do we want that, or does that simply push the coal trading business to somebody that's even shadier, even farther behind, underneath the radar? How do we read those kinds of statements?
Unless you suppress the demand, the supply is going to continue to flow. It's just moving. I mean, we have seen with oil and coal in particular has been an increasing number of the production is moving into what I call the shadows. Companies with less regulation, less transparency from public markets into private hands. I don't think that that's particularly good. I think that I will rather have coal producers listed on the New York Stock Exchange and financed by Wall Street banks, where I'm going to get information. I'm going to be getting a lot more transparency, and perhaps investor pressure could contribute to do better production, better mitigation, that all of that production moving into private equity or family-owned companies where literally we don't get any information whatsoever. But commodity traders are getting more into coal as other public markets get out. The commodity traders usually step in. They see it as a natural business. They see still the demand. I mean, the main problem with coal is that we have been talking about reducing demand, phasing out, et cetera, and coal demand this year in 2024 is going to hit an all-time high.
Okay. Questions? Taya, please. Thanks.
Hi. Thank you. Sorry. Very, very interesting. I guess that
Would you mind using the mic, actually, Taya?
Oh, sure.
Just right-
Sorry.
Yeah. Thank you.
No problem.
And you should say who you are, because you have a little bit of expertise on this subject.
Not on commodity traders so much, but on commodities in other ways. So on Theory of Franco's, I work, I guess right now I'm writing a book on the lithium sector. So I'll just set that up as, that relates to a couple of my questions. I have two, I think they're kind of connected. You can also just take one if I don't want to dominate the space too much. But I've read your work and followed you, and so I'm really interested in what you have to say on these two pieces. So one is lithium, and you can correct me if I'm wrong, and this may also apply to other critical minerals, though it sounds like not cobalt. You do see some of the big commodity traders moving into lithium, but overall, most lithium deals are these offtake agreements directly between the let's say the lithium miner and like the company that's buying it, the battery maker, the EV maker. So you don't see the daily trading. You see these like 10-year things. And I'm wondering if you think that's going to change. There's been a push to like basically bring lithium into commodity trading through the LME that hasn't really taken off. And I'm just curious, is it the market size is too small, it's too volatile? Like what's preventing a market like lithium from being brought into this world and keeping it in this kind of older offtake kind of world? And then the second, I guess, relates to nickel, but it could relate to anything. I mean, nickel's just an easy recent example. It makes sense that you're saying that commodity trading kind of creates elasticity in the market and therefore creates balance over time. But also we see all these moments where it does the opposite, right? And the famous thing is like the recent nickel run up a couple of years ago that created a tremendous crisis for the London Metals Exchange, and where you had this like dramatic increase in price due to a short sell position. But regardless, not important. But there are many examples where commodity trading creates volatility rather than smoothing it. So I'm just wondering what you think about that, because you sort of reference those arguments and dismiss them, but I'm curious if you think there's something to that. So thank you.
Thank you. No, two excellent questions. And just let me start with nickel and just perhaps for others in the room, what happened there effectively is the nickel price went from something like, I cannot remember the numbers, but something like $20,000 a ton to more than $50,000 a ton in the space of a day and a half. The market had to be shut down. It was extremely controversial. A lot of big banks were financing position, et cetera, et cetera. It was a typical squeeze. Someone was betting on the short side, so the prices were going to fall. The market started to go against that position. He had to buy back some of the positions because he could not cover the what we call the margin calls, the margin requirements to sustain his positions. And it was just a complete meltdown of the market. And it's one that is still ongoing, and it's going to be quite a lot of lawsuits on it. And you are right. I mean, in that case in particular, I mean, certainly commodity trading was adding to the volatility. I mean, it was funny enough, it was because someone was betting that prices were going to fall that the market ended just having the most spectacular rally that we have ever seen. I mean, the chart of nickel would just literally goes vertical to the moon. But if you look at, I'm skeptical on financial commodity trading adding to the volatility, because if you look at non-financialized metal markets, both ferrous and non-ferrous, you see very similar price increases. I mean, iron ore only now is developing a swap market, have seen massive price spike going to more than $200 a ton, and that's a physical market without any kind of financialization. So I'm not sure that I buy into the argument that financial commodity trading, in particular, the use of derivatives, add to the volatility. And we have seen a number of commodities that have gone stratospheric in recent weeks and months, that they don't have a financial market. I mean, one that is not metals, but is close to home because it's the market for olive oil, and Spanish extra virgin olive oil, which is what we consume at home, has gone from effectively about $2,000 a ton to $10,000 a ton because of a drought in Spain, et cetera, et cetera. There is no financial market for olive oil. There is just a very small commodity market, and it still has happened. So I can see that there are arguments where there are times where financial factors do play a big role. Nickel was one. Cocoa is a market where we are seeing that ongoing. And very similar also, people who are hedged, we have a short position on the financial market, and now they have to buy back their positions because they cannot meet the margin calls. So there is an addition of volatility at times, but I would not think that just generally increase prices as a general rule. And in lithium, again, you are absolutely right. LME has been, London Metal Exchange has been trying to create a market. I think that the biggest obstacle here is that it's a relatively small market in terms of value, nothing compared to copper and aluminum, and also the main interest of lithium is not much as the raw material, the commodity, but the semi-processed lithium that goes into the batteries. And I think that the traders then, they don't see then a role, because it's already, you need to have significant chemical processing facilities to do that lithium to refined product, semi-refined product. That's where the value is, rather than trading the raw material. And they see also a relatively limited market on the buying side. It's mostly the car companies. So at the moment, I think a small market, early days, but it's early days. I mean, can we see, lithium has been around for, say, as a commodity, probably only for about 5-7 years. If you look, for example, at the example of iron ore, 10 years ago, it only traded as a physical commodity. Today, it has a more sophisticated swap market. Give it a few years and we'll see where it goes. But I agree with you that so far we don't see much interest from the commodity traders on it. I think that's just too small for them.
Yeah. And I just say a really quick follow-up because it's interesting. I think it'll be interesting to others. Just a quick follow-up to the end. I was at a lithium conference a few years ago, and one of the main debates at that stage was, is lithium a commodity? And actually the different investment houses took different, and then the lithium companies themselves took different positions on that question. Basically, the lithium companies say it's not a commodity, and the investment houses say it is. And we can get into why that is, but that's not important. But something has to count as a commodity. It has to be.
I think a lot of people in the market will refer at lithium as a chemical product, exactly, rather than a commodity. I mean, chemicals are also commodities, but Thank you.
Any other questions? Yeah, please.
Yeah, so towards the end of your book, you kind of talk about the future of commodity trading and maybe profits threatened by increased competition, regulation, maybe in financial institutions, going to derivatives and all that. How do you think that has evolved since you wrote the book, and how do you see future opportunities for profit for these trading houses?
Well, first of all, I will say thank you for the question. First of all, I will say that we thought that we probably have seen the peak of the profitability of the commodity traders, and obviously we cannot not really anticipate that we were going to have one of the world's largest disruptions of economic life with COVID-19, followed by the invasion of Ukraine, followed by a war in the Middle East, which has turned to be quite profitable to the commodity traders. So one of the conclusions of our book was probably we have seen peak commodity trading profits kind of turn a bit off, to put it mildly. But look, I think that one of the arguments that we put on the book that was that a new wave of regulation was coming to the market has proved absolutely right. I mean, the amount of lawsuits filed by prosecutors against the commodity trading industry is unprecedented. The fact that several companies have pled guilty of serious crimes here in the United States, there are cases pending in the UK, in Switzerland. I think that I do believe that the industry will change, that some of the most established companies, some of the names that I just referred to, and they have been involved in cases of bribery, they cannot afford to have another plead guilty of bribery. I mean, it will destroy their business. The banks will run away from them. So the fact that prosecutors have got very serious about this, the fact that prosecutors, particularly in the United States, and with both administrations, this started under Obama administration, it followed during the Trump administration, it has continued under the Biden administration. For sure, the Department of Justice and the prosecutors are not taking political direction, but it does help that there is a bit of a push to bring this sector into transparency. I do think that that's gonna change. The fact that Jack and I have been fielding so many questions from central banks and regulators over the last couple of years, particularly after the European energy crisis, I do think that there is a lot more attention, and at least there is more awareness from regulators about this sector. I have not seen yet a lot of push for new regulation through policy. It has been much more has been by law enforcement rather than policy. But I do think that we are beginning to see a push that you cannot have a corner on the global economy that effectively is a black hole where central banks try to take a look and they come back and they say we simply do not have enough data to know what is happening. I mean, when you are having the interlink between commodity trading, financial markets for commodities, and commercial banks financing all of that, and a central bank wants to take a look and concludes we don't know, central banks are going to start doing things. But, I mean, recently I was invited to a conference organized by a major central bank, and I asked their chief economist, so how many people do you have looking at commodities? 1.5 economists. And I said, how many macroeconomists do you employ? It's about 250. I do think that, considering how important it is for the global economy, particularly for inflation today, it kind of felt to me like a no-brainer that they need to increase their look at this. But, I think that has been, particularly 2022 was a game changer in central banking and commodities, and we will see more interest there. But it's not an easy sector. I mean, there are some of these companies, if someone knocks at the door and say, can we see your financials? They simply can say, no, thank you very much, go away. We're a privately owned company, we do not need to show you any numbers. You will need, that's what I said at the beginning, transparency. I mean, Cargill, that's the largest privately owned company in this country. It used to publish every quarter their financials, and they did so for about 15 years. 2.5 years ago, they decided that they didn't want the public to know how much money they made, and they stopped publishing their financials. It requires then, a bit of journalism entrepreneurial activity to get their financials, and we do get their financials. And the last financials show that they made record profits of more than $6 billion. But the attitude of the industry is to give regulators and governments the least possible.
I mean, this is great. I have one more question I can't resist. I'm an IR prop, so I have to ask this sort of geopolitical question on my mind. And you could actually take this in a couple different ways, but one thing that you've talked about is sort of the need for data and transparency. And democracies, for all their various problems, are probably, at least on average, slightly more inclined to transparency than autocracies. Yeah. And we are moving from a world, say, I don't know, pick your date, pre-2015-ish, where there was relative cohesion in the world, to a world where we have a very, much more hostility between the great powers of the planet. To what extent, and I can imagine this going in three different directions, to what extent is that increased hostility geopolitically, does this help the traders? Does it hurt the traders? Or is it neutral for the traders, right? It's like business as usual. And I can imagine it going in all of those directions, but I'd love your thoughts.
That's a good question. I see what it's so complicated to be on the other side when someone is asking the question. Thanks, Jeff. Look, I think that particularly, I will not say as much as hostility, but trade barriers, protectionism is generally bad business for business in general. I think that commodity traders have benefited a great deal for the opening of global economies and for the thrive of globalization. So a reversal of that tends to be bad news. However, nothing is more profitable than a war of disruption, of sanctions, because it creates artificial disruptions that can be taken advantage by the traders. I mean, you can buy today. Just in mind that Russian oil can be bought for a discount to the normal market. I mean, the discount varies, but somewhere between $10 and $15, perhaps $20 at some point. But once that barrel of oil from Russia is refined on a refinery which is outside the G7 and the European Union, the product of those barrels are no longer Russian. It's made from the country where that refinery is located. So if you are a commodity trader, and we're just going to use some examples of trades that we are seeing. You could buy a barrel of Russian oil at $20 discount for the market, ship it to a refinery in India, and refine that barrel in India. The gasoline of those barrels are not anymore gasoline made from Russian crude, and therefore sanctioned. It is gasoline made in India, and that trades at the international price. So all of a sudden, in that example, you are making a 25% profit from the global market. You may have to grease the system in different places, so discount for those hidden costs, but you are still probably making a 20% margin to the prevalent price, and that is used on the back of sanctions and disruption of trade. When President Trump imposed trade barriers on China, and China retaliated and said, you know what, we're not going to buy you any more soybean from America, we're going to buy it from elsewhere. That creates a massive distortion of flows of soybean. Soybean that previously was going from America into China all of a sudden have to find a different way, a different home. That goes from from the US perhaps into Europe. Brazilian soy that previously going into Europe now all of a sudden had to be shipped into China. And all of those very significant disruptions to normal trade open arbitrage that they don't exist elsewhere and that they are massively profitable. So yes, directionally, you want less trade barriers, less protectionism, and a more harmonious geopolitics, because that usually was good for business. And the growth of the 90s and the 2000s, that really goes into that. I mean, the global economy was booming, the end of history, et cetera, and the last few years is reversing that. But at the very same time, some of those barriers are creating new opportunities for the commodity traders. Also, I will say
one last question.
On that is also not everyone is sanctioning the same way. Not everyone is creating a different level field. I mean, you are trading from what will allow me to say the West, the Europe, or North America, US, and Canada. You have a set of rules, but if you base yourself in, say, Dubai, you can trade on a complete different way with a new set of rules. If you are a trader from China, you have a complete new set of rules. And also, some of these traders are no longer, these entrepreneurial characters from the private sector. Some of them are these very entrepreneurial characters working for the Chinese government. China has created his own traders, massive trading operations, one of the largest ones, and more shadowy. I complain about the traders that we write on the book. These have a level of transparency. I mean, the traders in China, we know very, very little.
Right. There's a guy then. Yeah. Matthias is an expert on Chinese finance.
Yeah, so my question is obviously on the Chinese case that you, just to follow on what you said in the end. So China is the biggest trader in most commodities in the world, biggest importer of oil, as you mentioned. And the trade in that is a highly securitized issue in China. They use a lot of state-owned enterprises, trade bilaterally, even use Chinese companies at the source of the commodities. So I wonder how you see China's role in potentially squeezing the commodity traders going directly to the source, using state-owned enterprises instead of intermediaries.
That has been a huge concern by the independent commodity traders because they saw China having a very cheap source of capital, having a natural short position at home. A lot of those Chinese commodity traders are less of traders, are more of supply chains dedicated to service China. They are not trading commodities and be agnostic of where the commodity is going to end. They will just direct the commodity to wherever the market decides. They are going to direct the commodity. The soybeans are going to go from Brazil to China. They're not going to go to wherever the price is. It's just going to be, they are more about security of supply of China and less about the entrepreneurial character that we saw on commodity trading. They benefit from, as I said, cheaper source of capital, and also they benefit from other rules. I mean, the Chinese government is not really investigating the bribery of some of their home-grown commodity trading houses. They also benefit of the potential for a lot of barter deals where commodities are provided in return for other goods, and literally as barter. There has been some barter deals where it's oil for weapons, oil for Chinese manufacture. Increasingly also, they benefit from a non-dollar channel where they can help countries with under sanctions, be Russia, be Iran, to trade in non-dollar currencies, using the yuan or using barter deals. So they are a threat to commodity traders. The one problem, the independent commodity traders, the one problem that you have is that the business of commodity trading is about risk-taking. And the most essential function of inside a commodity trading house is basically managing that risk and the amount of risk that you are taking. And the Chinese traders so far have not been particularly good at managing the risk, and perhaps the incentives are not there. If you are a senior executive of one of those Chinese commodity traders, if you are making money for the state, well, you are doing your job, you're not going to get like any kudos. If you lose money, you're going to lose your job and perhaps something else. So the incentive for taking risk is not really there. I mean, you know, they tend to be quite conservative in the way that they trade. And sometimes, at least the view from, well, I will say the Western commodity traders is that often the way of taking risk is more punting the market, taking a view on the direction of the market based on perhaps inside information from within China rather than the arbitrage opportunities that I was describing. But certainly they are a threat, and China has created 3 big oil traders already, one huge agricultural commodity trading house, and a big metal commodity trader, although the metal one has had quite a lot of difficulties recently, and we don't know what the future is going to be of them. But they have created quite a lot of volume, and they are responsible for a significant chunk of volumes today.
Well, I know there are more questions. I hope that you'll take the chance to come up and talk to Javier at the end. But for now, I'd like to wrap up, and please join me in thanking Javier for his talk.
Thank you. Thank you so much. Thank you, Jeff.